Welcome to accountancy class for class 12, commerce. Today we will be discussing about accountancy for partnership firm fundamentals. So this partnership firm is one of the many business organizations where, due to some of the limitations, people have decided that they should organize a sort of business which we call it as a partnership firm. Mainly because of the sole proprietorship form of business organization, people have come to organize a business called partnership firm. They have realized that two heads is better than one. So many people with different skills, like their financial resources, then financial skills or management skills, and with different knowledge, have come together to organize a business organization called partnership firm. So today we will be discussing about the partnership firm, only the fundamentals. So in this session, the partnership firm was defined in Section 4 of Partnership Act 1932, where it states that partnership is a relationship between two or more persons who have agreed to share the profits of the firm, carried on by all or any one of them acting for all. So the definition clearly states that it is an agreement between two or more persons. Two or more persons where they have agreed to share the profits of a firm, carried on by all, or where any of them acting for all or on behalf of all the partners. So out of this definition, we can see some of the essential features of partnership firm. That is, out of definition given in Section 4 of Partnership Act 1932, we can draw some of the essential features like there should be at least two persons. So in a business firm, if the firm consists of only an individual person, it means that it is a sole proprietorship. But in a partnership firm, there should be at least two or more persons, where it can be termed as a partnership firm. So next is we have agreement. So there should be an agreement. There should be an agreement between the partners. So this agreement, according to the provision of a Partnership Act 1932, it states that it can be a written, oral, or it can be an implied. So there should be a clear-cut agreement so that in future course of time, in case if there is any dispute that arises between the partners, it can be amicably settled referring to their written agreement. So it is always advisable to have an agreement in written. Next is we have a business. So if there is no business activities within the firm, it cannot be termed as a partnership firm. But there should be a day in and day out transaction in a firm. That is called a business where these partners should undertake in a partnership firm. If there is no business, it cannot be termed as a partnership firm. Next we have sharing of profits. The profit that is arising out of the activities that they carry on in a partnership firm should be shared among the partners of the firm. It can be equally or it can be in a agreed ratio. So the profit cannot be taken by a particular partner, leaving some of the partners. But the profit has to be shared among the partners of the firm who contributes and who invest their money and then take the active part in a partnership firm. Next is mutual agency. This mutual agency implies that any of the partner can be an agent to other partners. For example, if there is a partner A, B and C, B and C can be an agent to the A, and AB can be agent to the C, and also C can be an agent of A and B. So there should be a mutual agency. That means there should exist a mutual trust between the partners. We have also one thing, that is, students always get confused with the partners, firm and firm's name. Let us have a clear-cut idea between these three. Partners are people or individuals who have interest to run a partnership firm. These individuals are individually called partners. Firm is a type of business, is a organization, a partnership organization where the partners organize under a separate type of business. And also firm's name is that the nomenclature that the firm name gives a name to this particular firm that they organize and run. There is one very important provision that is given in a Partnership Act 1932 in the absence of partnership deed. That is, first we have in the absence of partnership deed, we have salaries and commission. In the absence of partnership deed, if nothing is mentioned about the salaries and commission in a partnership deed, that means no salaries, no commission is paid to the partners for undertaking for shouldering the activities or burden of the partnership firm. No commission, no salary is paid. Next is we have sharing of profit and losses. So in case if there is no provision regarding the sharing of profit and losses, the sharing of profit and losses are done equally among the partners of a business. In many of the questions, please note that in many of the questions, the ratio is not given. So students get confused how this profit and losses has to be distributed among the partners of the company. Therefore, you should remember that there is no provision in a partnership deed in that particular case. So the profit and losses are shared equally. In other words, if nothing is mentioned about the ratio of sharing of profit and losses among the partners of the partnership firm, that means the profit and losses are shared equally. Next we have is interest on capital. So this is a seed money. This is an introductory money that is invested by the partners towards the partnership firm. So if nothing is mentioned about the rate of interest, no interest is charged on the capital that has been invested by the partners. Next is we have interest on advances and losses. There are also cases where partners give an advance or loan towards the partnership firm, which is different from their individual own. So in this case, 6% of interest is charged on advances and losses. Here also, there may be certain cases where the rate of interest may not be mentioned. Therefore, you will have to ascertain on which date or in which month the partners are advancing loans and advances. From there, you will have to calculate the number of months and charge the rate of interest at 6%, though the question hasn't mentioned anything about the interest on advances and loans. Next, we have interest on drawings. So these drawings are something that is withdrawn by the partners for personal use. Therefore, no interest is charged by the firm for withdrawing certain sum of money in goods or in kind. These are some of the very important provisions that has been given in Partnership Act 1932 in the absence of partnership deed. Next we have Next we have capital accounts. There are two methods of maintaining capital accounts. First we have fluctuating capital account and fixed capital account. Let me go to fluctuating capital account. This fluctuating capital accounts, as the name indicates, keeps on changing. Sometimes it may decrease and sometimes it may increase. Under this fluctuating capital account, only one account is prepared, that is capital account. So under this fluctuating capital account, the transactions relating to the partners are recorded in a separate capital account for all the partners. For example, share in the profits and losses, or it may be commission, salary, or it may be some lump sum that is paid towards the partner. So all these transactions are recorded in his capital account, where the capital amount will increase sometimes and sometimes it may decrease. Therefore, it is called a fluctuating capital account, where capitals of the partners keep on changing year after year. Next, we have fixed capital account. Under this fixed capital account, we prepare two accounts, that is capital account and partner's current account. So in this fixed capital account, unlike in the fluctuating capital account, all the transactions are recorded in partner's current account. So only the introductory capital account or withdrawal of capital amount will be recorded in his capital account, and the rest, the transactions, like I told you before, commission, or it may be salary, or it may be sharing of profit and losses, will be recorded in current account, partner's current account, where the capital, once it is introduced, will remain fixed and it will never change, but the amount of current accounts keeps on changing. Therefore, when you compare this fluctuating and fixed capital account, they are just the opposites. And next we have meaning of drawings. Drawings is something, whether it is a cash or in kind, that has been withdrawn by the partners for their personal use and not for business use. If it is withdrawn for business use, it is not a drawings. But if certain amount or certain goods that is already in the business has been taken by the partners, it is called drawings. So interest on capital is a gain to the partners. When there is a provision that partners should get certain sum of money for the interest that they have invested in a partnership firm, it is a gain to the partners. But if certain rate of interest is charged towards the drawings, it is a gain towards the firm. When there is a drawings with the interest on drawings, it is a gain. The partnership firm is earning an income out of the drawings. There are certain cases where the date of drawings by the partners are not given in a cushion. So if you come across this type of problem, that means 6 months interest is charged on drawings by the partners. So you should remember that if the date of drawings are not given in the cushion, that means 6 months is taken into account for calculation of drawings. Next we have is goodwill. Meaning of goodwill. Goodwill is an intangible asset. It cannot be seen, at the same time it cannot be touched. But it is a reputation of the partnership firm, where we can conclude that all customers resort to the old bliss. It is, in other words, a income over and above the normal profit. That means they are earning a super profit. There may be two partnership firms getting on with the same types of business, but if a particular firm is earning over and above the other firm profit, that means they have a very high goodwill. That means they have a good reputation. So this goodwill is an intangible asset, but not a fictitious asset. Therefore, it is an intangible asset where when you draw an accounts, you are required to prepare, you are required to calculate the amount of goodwill. Therefore, in this problem, we use average profit method, then weighted average profit, super profit method, capitalization of super profits, capitalization of average profits, where you will be most of the time using average profit method and weighted average method. So under average profit method, you have average profits into number of years purchase as your formula. Then you have also weighted average method, second one, that is you have weighted average profit into agreed number of years purchase. You have super profit method, that is super profits into number of years purchase. Then capitalization of super profit, you have super profits into 100 by normal rate of return. Then you have last one, capitalization of average profit, that is capitalized value minus net assets. So of all these, there should be an agreement. We call it as a partnership deed. This, as I've told you before, partnership deed is a written document. It is a written document containing the terms and conditions of partnership agreed upon by all the partners. So the importance of having a written partnership deed is that they are an evidence for future dispute, and this partnership deed has to be agreed and signed by all the partners. One very important thing is we have a past adjustment. This past adjustment needs a thorough calculation where the past adjustment requires that there is, in certain cases, there are omission of salaries, commission, and then there are also omissions of sharing in profits and all those things. So if there is an omission of these particulars, the partnership firm will not show a correct profit position. Therefore, we need to have a past adjustments to ascertain a correct position of the firm. Therefore, you should remember this: the definition of partnership firm, essential features, provision of Indian Partnership Act 1932 in the absence of partnership deed, and also we have capitals accounts, then meaning of drawings, meanings of goodwill, then calculation of goodwill. At the same time, remember the past adjustment, calculation of past adjustment, then partnership deed. With this, we have come to the end of these sessions. In the next session, we will be doing some practical problems relating to the partnership firms, that is fundamentals, how to go about this. With this, I wind up my session. Thank you.